In Chapter 5, we are going to look at the forms of business ownership. The three most common forms of business ownership are sole proprietorship, partnership, and corporation. Each form has its own characteristic internal structure, legal status, size, and fields to which it is best suited. Each has key advantages and disadvantages for the owners, which we will cover in the next few slides. A sole proprietorship is a business owned by one person, although it may have many employees. It is the easiest and least expensive form of business to start. Many farms, retail establishments, and small service businesses are sole proprietorships, as are many home-based businesses such as caterers and consultants. The advantages and disadvantages are listed here for you, but I want to focus in on one of each. The advantage that I want you to really know is the tax advantage that a sole proprietor receives. The tax advantage is that all of the income from a sole proprietorship is seen as the personal income of the sole proprietor. This means that they are taxed at individual tax rates. The disadvantage is a concept known as unlimited liability. Unlimited liability states that from a legal standpoint, the owner and the business are one and the same. That means that the owner is responsible for all debts, lawsuits, and risks associated with the business. In other words, a sole proprietorship could lose everything if they are sued or declare bankruptcy. The owner's personal assets and the business assets are not separate. If starting a business on your own seems a little intimidating, you might decide to share the risk and rewards of going into business with a partner. In that case, you would form a partnership, which is a legal association of two or more people as co-owners of a business for profit. Partnerships have two basic types that are listed here. General partnerships is a type of partnership where all partners are considered equal by law and all are liable for the business debts. To guard against personal liability exposure, some organizations choose to form a limited partnership. Under this type of partnership, one or more persons act as the general partner who run the business, while the remaining partners are passive investors. That is, they are not involved in managing the business. These partners are called limited partners because their liability, which is the amount of money that they can lose, is limited to the amount of money that equals the amount of their capital contribution. This slide shows some partnership advantages. I want to mention the tax advantage to you guys. This is also where the income from a partnership is taxed at the individual tax rate, which is an advantage. Other advantages are that you get a diversification of risk and you have additional skills since there is more than one person involved in the partnership. Some partnership disadvantages include unlimited liability and interpersonal problems. Now let's review what we just talked about on the previous two slides. Remember, a general partner is the partner that runs the day-to-day business. That is the partner that has the unlimited liability. This means that they are responsible for all debts and lawsuits that may occur. Other issues with partnerships involve interpersonal problems. This is something to consider when you have to have it laid out how you are going to deal with unproductive partners. A corporation is a legal entity with the power to own property and conduct business. A corporation can receive, own, and transfer property. They can make contracts, sue, and be sued. Unlike the case with sole proprietorships and partnerships, a corporation's legal status and obligations exist independently of its owners. Here it says how corporations face limited liability. That is because what I just mentioned. The owners of most corporations are the shareholders, and the shareholders are not responsible for the personal debt of the corporation. All they can lose is the amount that they have invested in the stock of the company. As I just mentioned, the corporation is owned by its shareholders who are issued shares of stock in return for their investment. These shares are represented by a stock certificate and they may be sold or given to upon death of the owner to someone else. The stock of a private corporation such as Mars Corporation is held by only a few individuals or companies and is not publicly traded. By withholding their stock for public sale, the owners retain complete control over the operations and ownership. Private corporations finance their operating costs and growth from either company earnings or other sources such as bank loans. By contrast, the stock of a corporation such as Google is held by and available for sale to the general public. Thus, the company is said to be publicly traded. Here are some advantages of corporations. There's increased liquidity, increased access to capital, limited liability for the shareholders, and unlimited lifespan. Unlike a sole proprietorship that might close with the death of the owner, it really doesn't matter who the CEO of the company is with the corporation in terms of the longevity of the life of the corporation itself. This slide lists the disadvantages of corporations. The paperwork and costs associated with corporations can be burdensome, particularly if you plan to sell the stock. In addition, corporations experience what is called double taxation. That means they are taxed twice. They must pay federal and state corporate income tax on the company's profits, and individual shareholders must pay income taxes on their share of the company's profits received as dividends. This is an important negative disadvantage of corporations. Shareholders of a corporation can be individuals, other companies, nonprofit organizations, pension funds, and mutual funds. All shareholders who own voting shares are invited to an annual meeting to choose directors, select an independent accountant to audit the company's financial statements, and attend to other businesses. What is important here is when you look at this diagram, it shows that the common shareholders, as I just discussed, elect the board of directors. Those board of directors then appoint the C-level or corporate officers of the company, who then hire the employees of a company. If shareholders are not happy of the direction that a publicly traded corporation is heading, these shareholders can turn over the board of directors, which may result in a new direction for the company. This slide looks at different ways that businesses can combine. In a merger, two companies join to form a single entity. Traditionally, mergers took place between companies of roughly equal size and stature, but mergers between companies of vastly different sizes is common today. Companies can merge by either pooling their resources or through a purchase of the assets of one company by the other. Although not strictly a merger, a consolidation in which two companies create a new third entity that then purchases the original two companies is often lumped together with the other two merger approaches. In an acquisition, one company simply buys a controlling interest in the voting stock of another company. Unlike the real or presumed marriage of equals in a merger, the buyer in an acquisition is definitely the dominant player. In most acquisitions, the selling parties agree to be purchased. However, in a small minority of situations, a buyer attempts to acquire a company against the wishes of management. In these hostile takeovers, the buyer tries to convince enough shareholders to go against management and vote to sell. A leveraged buyout occurs when one or more individuals purchase a company's publicly traded stock by using borrowed funds. The debt is expected to be repaid with funds generated by the company's operations and often by the sale of some of its assets. Here are some advantages and disadvantages of mergers and acquisitions. One of the advantages mentioned is the economies of scales that we talked about a couple of chapters ago. The disadvantage that I want to talk about for a second is the culture clashes. A lot of times in acquisitions and mergers, cultures of the two companies and whether they are compatible or not is ignored until it's too late and problems are evident. Unfortunately, this can cause high turnover in companies, which is also expensive for the companies. My advice is if you are ever in a management position when a merger or acquisition is occurring, make sure you pay attention to the cultures of the two companies. On this slide, we talk about different types of mergers. A vertical merger occurs when a company purchases a complementary company at a different level in the value chain. This means they either purchase a supplier, a distributor, or a customer. An example might be when Toyota bought the company that used to produce the brakes for its cars, and now it owns that company. A horizontal merger, on the other hand, involves two similar companies at the same level, such as the combination of two car manufacturers, two banks, or two retail chains. In a conglomerate merger, the two firms offer dissimilar products or services, often in widely different industries. An example of this would be if a food company bought a battery company. A market extension merger combines firms that offer similar products and services in different geographical markets. Companies pursue a product extension, on the other hand, when they merge and they feel the need to expand their offerings of goods and services, but they lack the time or resources to develop these products internally. Every corporation that sells stock to the general public is potentially vulnerable to a takeover by an individual or company that buys enough shares to gain a controlling interest. Basically, a hostile takeover can be launched in one of two ways. The first way is tender offer, and the second way is proxy fight. In a tender offer, the raider offers to buy a certain number of shares of stock in the corporation at a specific price. The price offered is generally more than the current stock price so that the shareholders are motivated to sell. The raider hopes to get enough shares to take control of the corporation and to replace the existing board of directors and management. In a proxy fight, which is also known as a public relations battle, this is when the raider launches the battle for shareholder votes, hoping to enlist enough votes to oust the board and the management. Corporations have figured out how to defend themselves against unwanted takeovers. Sometimes they work, sometimes they don't, but we're going to talk about 3 of them here. The poison pill. This plan is triggered by a takeover attempt, and it makes the company less valuable in some way to the potential raider. The idea is to discourage the takeover from actually happening. An example of this, let's say, that P&G found out that somebody wanted to buy P&G because of the brand Tide. P&G, as a poison pill, could potentially sell off Tide so that the raider leaves them alone and leaves the rest of their portfolio intact. And the shark repellent tactic, this one is more direct. It is simply a requirement that stockholders representing a large majority of shares approve of any takeover attempt. Of course, such a plan is viable only if the management team has the support of the majority of shareholders. And finally, the White Knight. This is a third company that is invited to acquire a company that is endangered of being swallowed up in a hostile takeover. White Knights usually agree to leave the current management team in place and to let the company continue to operate in an independent fashion. In the last 2 slides for this chapter, we're going to talk about strategic alliances and joint ventures. A strategic alliance is a long-term partnership between companies to jointly develop, produce, or sell products. A joint venture, on the other hand, is a special type of strategic alliance in which 2 or more firms Jointly create a new business entity that is legally separate and distinct from its parents. An example of a strategic alliance that I'm familiar with is there was a startup beverage company that did not have enough money to build its own bottling plant. It knew that there was a beer company who had some of their bottling lines lying idle and not making the company money. The two companies formed a strategic alliance in which the beverage company paid the bottling company money to use their bottling lines. This worked out because then they did not have to have the initial investment to build their own bottling plant, and the beer company was able to make money off of a line that was previously sitting idle. The beverage company actually went on to be very successful and build its own bottling plant, and then once they did so, the strategic alliance ended. Joint ventures are more permanent. They have advantages and disadvantages, but they allow companies to use each other's complementary strengths that might otherwise take too long to develop on their own. And they allow companies to share what may be the substantial cost and risk of starting a new operation. The important thing to remember about a joint venture is that the new company is distinct from its parent companies. An example of this is Sony, which is a technology company, formed a joint venture with Ericsson, which was a telephone cell company, and they formed a third company known as Sony Ericsson. Please let me know if you have any questions on Chapter 5.